Hey traders and investors, it's Serge Berger here. What we're going to take a look at today is a little bit of context on this high frequency trading uh, debate that's out there, or actually we're going to try to sidestep that and just get a little bit of more of a neutral point of view and what does it actually mean for the majority of at least retail traders. Okay, so this high frequency stuff, of course, it's all it's rooms full of computers like this that basically just takes away the last couple of digits on a stock trade and resells it to you at a higher price kind of thing. You actually, as a retail trader, to get right to the point, the retail trader should not care if you execute your own trade. If you are buying mutual funds, then it indirectly actually could affect you over time. But for purpose of today's discussion, for active traders and investors, if you are dabbling in stocks and you're holding those stocks for more than one day, which is the majority of the cases, the majority of people buy a stock and look to profit from it anywhere from 5 to 10% and resell it at some point over the next few weeks, maybe a couple months. That's what the majority of retail folks try to do, and quite frankly, it's what majority of institutions do, except they have a little bit of a longer time frame. But for individual investors, honestly, it doesn't matter. Okay, and I'm going to get some pushback in that, but I'll give you an example of why. Let's assume you're buying right now. You want to buy Ford at something like $16.30 because you think the stock here at this point is going to move above this 200-day moving average, this red one where it's at right now, because you're seeing what I'm seeing, which is basically the stock is broken past some lateral support lines, it's broken this resistance line, blah blah blah. But you think the stock's going to move higher. You think over the next few weeks, maybe a couple months, this stock is going to move from around 1630 up to 1750, which more or less gets you to about a 7% gain. Again, that's what the majority of retail traders do. Now, if you have this type of goal, 7% move, which again is a typical example, do you really care whether you buy your stock at $16.30, $16.31, or even $16.35? Honestly, if this is your type of example, your 7% gain with maybe you have a 2-3% stop loss, if you really care about those 2, 3, maybe even 5 cents in this case, which represents a 30 basis points, so 0.3%, you probably are micromanaging the trade. Now, let me be very clear before I get all sorts of email about this. I don't think HFT is what's going on. Some of the stuff that's going on, to the extent that I can understand it, is right. I think there is a little bit of front running and stuff like that happening. Do I think that needs to be curated? Yes, absolutely. It does need to be. This needs to be taken care of. This cannot happen. My point is, if you are spending, half of your day, as I've come into some people over the past few days that are just literally up in arms and they're trading, 100 shares of eBay. If you, and holding it a couple of weeks, if you really are up in arms about that, about your own trading, and you're letting this get in the way of a profitable trade, then my advice is don't. Okay, there's enough people behind it, from the FBI to 100 other agencies that are trying to work this around. So if you're letting this get in the way of a profitable trade and really messing you up mentally, then please don't worry. It does not matter. The ratio of what you're losing here, even if that's the case, and I'm giving you a dramatic example of 30 basis points, all right? But even in this extreme example, it is not worth fretting about. It does not change the dynamics of for the most part, most retail equity traders, how they operate if they execute their own trades. I hope this makes sense. Any questions, as always, please hit me up on my Twitter handle, which is SteadyTrader. Take care.